In the year 2000, Enron was the seventh largest company in the United States. 62% of its employees' retirement savings sat inside Enron stock. 15 months later, the stock was not down 50%, not down 90, it was zero. 20,000 people lost their jobs and over $1 billion in retirement assets in a single, mathematically uninteresting event. This is the story every concentration disaster tells. It is not bad luck, it is the math of one variable carrying everything. Before 1952, finance had a different obsession. The question every investor asked was the same one: which stock will go up? You read balance sheets, you studied management, you tried to find the next great company before anyone else did. Diversification was discussed, but vaguely. Benjamin Graham, the father of value investing, wrote that you needed an adequate but not extreme number of positions. Nobody had a formula. Then a 25-year-old Chicago graduate student named Harry Markowitz walked into a finance seminar and asked his thesis advisor whether he could study the stock market. His advisor said yes. Markowitz read the existing literature and noticed an absurdity. If investors only cared about expected return, every investor should put every dollar into the single stock with the highest expectation. But nobody did, so they had to be caring about something else. That something else was variance. The dispersion of outcomes, the width of the bell curve around the average. Investors did not just want a high mean, they wanted a narrow distribution around that mean. They wanted to know they would actually arrive somewhere near the average, not at one of the bad tails. Markowitz wrote a 14-page paper in 1952 titled Portfolio Selection, and that paper changed every retirement account in the world. The paper said, a portfolio is not a list of stocks. A portfolio is a system with its own variance, and that variance is not the average of its parts. Adding the right second stock can reduce risk without reducing expected return. There is a free lunch sitting on the table. The seminar room was hostile. Milton Friedman said the dissertation was not economics. Markowitz got his PhD anyway. 38 years later, he got the Nobel Prize for the same 14 pages, and every index fund, target date retirement product, and pension allocation in the developed world traces its math back to that paper. The Markowitz formula for the variance of a two-asset portfolio looks like this. Sigma squared P equals W1 squared sigma 1 squared plus W2 squared sigma 2 squared plus 2 W1 W2 RO12 sigma 1 sigma 2. In plain language, portfolio variance is the weighted variance of the first asset plus the weighted variance of the second plus a cross term that captures how the two assets move together. The cross term is where the magic lives. The Greek letter rho is the correlation coefficient between the two assets. It runs from -1 to +1. If rho is +1, perfect positive correlation, the two stocks move in lockstep. The cross term is at its maximum. The portfolio variance is then exactly the weighted average. You get no benefit. But if RHO is less than 1, and for any two actual stocks it always is, the cross term is smaller than the maximum. The portfolio variance falls below the weighted average. Risk disappears. For the limiting case, imagine two stocks with equal volatility sigma, equal weights of 50%, and zero correlation. The formula collapses to sigma squared divided by 2. Portfolio standard deviation is sigma divided by the square root of 2. That is roughly 71% of either stock's volatility, and you gave up nothing in expected return. This is what Markowitz called the only free lunch in finance, generalized to n independent stocks of equal volatility, equal weight. Portfolio variance is sigma squared divided by n. Portfolio standard deviation is sigma divided by the square root of n. 5 stocks cut volatility by roughly 55%, 25 stocks cut it by 80%, 100 stocks cut it by 90%. But real stocks are not independent. They move together because the economy moves together. The average pairwise correlation of stocks inside the S&P 500 is roughly 0.3. So the diversification curve does not fall to 0. It falls to a floor. That floor is what Sharpe in 1964 called systematic risk. The variance above the floor is unsystematic, firm-specific noise. The market pays you an expected return for taking systematic risk. The market does not pay you for taking unsystematic risk, because you could have diversified it away for free. Concentration is unpaid variance. This episode is sponsored by my private deep dive library. If the math behind diversification, the covariance terms, the systematic floor, the geometry of the efficient frontier is the kind of thing you want to actually understand and not just read about, the library has full courses on portfolio theory, risk management, and applied mathematics for investors who want the formulas behind the headlines. Link is in the description. Now, back to the math of why concentration is unpaid risk. Now here is the trap. Almost every investor I have ever spoken to says the same thing. I diversify, I own 5 stocks, I own 7. And the math says gently, that is not enough. 5 stocks captures very roughly 75% of the diversification benefit available to you. The other 25% is sitting on the floor, free, and you are walking past it. More importantly, with 5 stocks, each one is 20% of your portfolio. One Enron in a 5-stock portfolio is a 20% allocation to a 100% loss. The illusion of being diversified is its own cognitive trap. We frame concentration as conviction. We say things like, I really believe in this company, so I'm going large. The market reads that the same way it reads any large position, as unpaid variance. The market does not know your conviction. It knows your covariance, and it will not pay you for the part you could have diversified away. There is a second, deeper trap: home bias. The behavioral economics literature is dense with the finding that investors overweight what they know: their own employer, their own country, their own industry. The Enron employees were the case study. Many of them did not just hold company stock in their 401k. They worked there, they lived in Houston, their friends worked there, their houses were on Enron employee mortgages. When Enron failed, their entire financial life had a single point of correlation: their portfolio, their job, their housing, their social network, all RHO equals 1 with one company. The math does not care about loyalty. The math only counts how many independent draws you took. A portfolio of 1 is a portfolio of 1 regardless of how strongly you feel about it. And the standard objection, but I research my picks, runs into the same wall. Research, by definition, can only use information that the market does not already have. If the information is public, the price already contains it. If the information is private, you should not be trading on it. The retail investor who tells you they have an analytic edge over the aggregate of every hedge fund, pension fund, central bank, and computer algorithm in the world is making a very large claim, almost always without evidence. Case 1. Enron, December 2001. At the peak in August 2000, Enron stock was $90.75 a share. 62% of the company's 401k retirement plan sat in that stock. Senior management knew before the public did that the accounting was fictional and sold their personal holdings on the way down. Employees were restricted from selling during the critical window. The stock closed at 26 cents on November 30, 2001, 2 days before Chapter 11. Roughly 20,000 people lost their jobs and over $1 billion in retirement savings. The number you have to keep in front of you is the 62%, not the bankruptcy, the pre-bankruptcy concentration. Case 2. Lehman Brothers, September 2008. Different decade, same pattern. Employees of Lehman Brothers held roughly 10 million shares of company stock in their retirement and stock incentive plans when the firm went bankrupt on September 15th. The shares went to zero in the same way Enron's did. The employees were told repeatedly by senior management to hold. Many did. The concentration story is the same story. Case 3. Hendrik Bessembinder, 2018. This is the hardest finding to internalize. Bessembinder at Arizona State examined every single United States common stock listed between 1926 and 2016, about 25,000 stocks. He asked a simple question: what fraction of these stocks generated the market's total wealth creation? The answer was 4.31%. Roughly 1 in 25 stocks created all of the $34.8 trillion of net shareholder wealth that the U.S. stock market produced over 90 years. The other 95% collectively returned the same as 1-month Treasury bills, or less. The median individual stock lifetime return was negative against T-bills, which means if you pick a stock at random, the most likely outcome is that you would have done better in a savings account. Case 4. Bogle, 1976. In August 1976, John Bogle launched the first index investment trust, $11 million in initial assets, mocked by Wall Street as Bogle's folly. His logic was the inverse of Bessembinder's. If you cannot tell the 4% of winners from the 96% of losers in advance, then own all of them. Don't look for the needle, he said, buy the haystack. Vanguard today manages over $9 trillion. The S&P 500 index has beaten 88% of U.S. large-cap active funds over the 15-year period ending 2023. Here is the structural insight. The market does not pay you for taking risk you could have eliminated for free. It only pays you for risk you have to take in order to participate in the market at all. Sharpe in 1964 formalized this. Total variance equals systematic variance plus unsystematic variance. The market prices systematic variance. Call it beta. The market does not price unsystematic variance. Bringing unsystematic variance into your portfolio brings you risk without expected return. Concentration is not conviction. Concentration is unpaid risk. You are taking variance the market refuses to compensate you for, and the only justification for taking it is informational, that you know something the market does not. Most of the time, you don't. Most of the time, what you have is a story. The free lunch language Markowitz used was not casual, it was technical. Almost every other risk reduction tool in finance, moving to cash, buying puts, hedging, costs you expected return in exchange for lower variance. Diversification is the unique exception. Its only price is the discipline of giving up the fantasy that you can pick the 4%. The logic of why the market refuses to pay for unsystematic risk is worth pausing on. In a competitive market, anything you can do that anyone else can also do at zero cost gets priced away. Diversification is free. Therefore, any investor who refuses to diversify is taking risk that the marginal investor, the one setting prices, has already eliminated. The market sees no reason to compensate you for a bad decision you did not have to make. The compensation only attaches to the residual variance you cannot escape, the systematic part, the part that moves with the economy itself. This is also why index funds work. An S&P 500 index fund is not a clever investment idea. It is the absence of a clever investment idea, executed at low cost. It owns the 4% winners, the 96% losers, and weights them by the market's own aggregate vote. The fund collects the systematic return and pays you nothing for unsystematic risk because there is none. The total expense ratio on a Vanguard 500 fund in 2024 is 0.03%. $3 a year on every 10,000. That is roughly the cost of the free lunch. There is a famous counter-argument worth stating fairly. Warren Buffett, in his 1996 letter to Berkshire Hathaway shareholders, wrote, "Wide diversification is only required when investors do not understand what they are doing. Concentrate," Buffett argued. Find the few exceptional businesses, hold them forever, don't dilute the result with mediocrities. He has run a 60-year track record that almost no diversified portfolio has matched. Let me take that seriously. The Buffett position assumes informational edge. You can pick the 4% because you have an analytic capacity, a temperament, and an information set that the median investor does not. Buffett does, most readers do not. The empirical record is that 95% of active funds, managed by full-time professionals with research staffs and Bloomberg terminals, lose to the index over 15 years. The question is not whether some investors have edge, some do. The question is whether you are one of them and whether you are willing to bet your retirement on the answer. Here is the deeper version. If you have edge, concentrate. If you do not, diversify. The fatal error is not knowing which one you are. Almost every Enron employee who held 62% of their 401k in company stock would have told you in 1999 that they had edge. So we end on the question every Enron employee asked themselves in 2002. They asked, how could we not have seen it? The honest answer is they did not need to see it. They needed to never have been concentrated. 62% of one company is a violation of the math, regardless of whether the company is good or bad. The bad company version of the story is loud and shocking. The good company version is quieter. It just means you happen to win, and you mistake winning for skill. Either way, concentration is unpaid risk. The 8-episode arc behind us: compound, decay, variance, zero, multiplier, weapon, creep, 2 tags, and now diversification, share one thing. Every one of them says the same sentence in a different costume. The math does not negotiate. Next time we look at diversifying not across stocks but across time. Dollar cost averaging. How the same Markowitz logic applies to the timing of every entry you ever make. Until then.